This is how I pick stocks. In this video, I will share the 5-step process that I use to decide if a stock is a good investment or not. We'll cover everything from idea generation to fundamental analysis, and I will share my valuation methods to help you build a strong portfolio that will generate great returns. Don't forget to hit the like button, and let's start with the first step, which is the idea generation. In the stock market, you have thousands of stocks. You won't be able to analyze everything. You have to be selective. But where do you start? That's a good question. I personally start with the companies I'm familiar with. It can be Apple or Starbucks or Disney or Google, etc. I'm a customer of these companies, so I know the products, I know the services. That's a good starting point for the analysis. Another way to generate more stock ideas is to run a screener. The goal of the screener is to filter out bad companies and only keep the companies you want. If you want to invest in strong growth companies that have generated strong earnings growth, 20% earnings growth for the past 10 years, you can do it. And you will find dozens of companies that match your filter. Let me share my screen right now. I'm on FinChat. This is the screener tab, and I have put 3 filters. I only want companies that have grown their revenue 5% per year for the past 10 years. I only want companies that have grown their earnings per share, EPS, 15% per year for the past 10 years. And I only want companies with a return on equity, ROE, above 15% for the past 10 years. That's a measure for efficiency. So I want companies with a good revenue growth, a very strong EPS growth with a lot of efficiency. These are 3 filters, but you can add any filter you want, any criteria you want. For example, if I want companies with low leverage, I can put a filter for debt, which is debt divided by equity here. So let's put 0.5, run screener. This is very easy, and you will find plenty of good opportunities. You see the big ones, Alphabet, Meta Platforms, Tencent, and if you scroll down, you will see smaller companies that fit your criteria. And if you continue, you have another page. That's 50 potential investments. That's a good amount of work that you can do here. And if you continue, another 50. And you can continue again and again. These are potential investments for you. And if you only want to invest in companies in the US, you can scroll up, countries, United States here, and you will find them. So plenty of good opportunities. And if you don't want to invest in the biggest companies, you only want the small caps, the small companies that will generate good performance, you can screen for market cap. This is in millions. So for example, I want 3 billion market cap at a maximum. And I don't want micro caps. So let's say I want companies that have 1 billion of market cap. So between 1 billion and 3 billion. And we will find companies that fit our criteria. We only have 1, 2, 3, 4, 5, 6, 7, 8 companies that fit our criteria. So these are good investment opportunities. You have generated 8 potential investments. So with stock screeners, the idea generation process is very easy, and you can be very restrictive. You can start with some filters, and you will have results of hundreds of companies. So you increase the threshold, you are more restrictive with your filters, and at the end you see 8 companies. By the way, if you want to outperform the market with a proven investing strategy, I've created a free guide that shows you how to do it step by step. Just comment guide below and I'll send you the link to access it on demand. So once I have my list of stocks of potential investments, I go to step 2, which is to understand the business. The idea here is to start researching the company, and I want to see if I really understand the business, if I really understand the company segments. So what do they do and how do they earn money? I want to understand the revenue nature, so whether revenues are contractual, recurring, or seasonal. I want to understand the geographic operations of the company. If the revenues of the company are mostly in Europe or in Asia, America, that's a different game. I want to understand who the stakeholders are, who the customers are, the suppliers, the employees, the regulators, management, everything like this. How do I find all this information? You can go to the company's website and see how they operate. So you have a good idea of what they sell, how do they talk to their clients, if you have some videos on the internet. That's a good starting point. You can also look at annual reports and quarterly reports. I love digging into annual reports. So That's long documents with many hundreds of pages, but you will have anything you're looking for. You will have in details everything that the company does, and that's a very good source of information. And I also look at investor presentations or recent filings or even blogs in the internet. A website that I use a lot is Value Investors Club. It's a website where people write analysis on stocks, and that's really well written, so you can get plenty of good information about a company. I also read Substacks, blogs, Twitter accounts. The internet is infinite, so you have a very good amount of information completely for free. And with all this data, you can see if this is a good company for you or not, if you really understand the company or not. You have a good idea of how the company operates. Sometimes when there is too much information, I can do a SWOT analysis, which is strengths, weaknesses, opportunities, and threats. You categorize things to see, okay, this is good, this is not good. And what is important with all this research is to identify the key performance indicators, the KPIs of this business. These are the most important metrics of a company. It's a good way to monitor things over time. You don't want to monitor everything. If you figure out 3 or 4 KPIs, that's a good way to see if this is a good company at the moment or not. You see what is really important. Because the problem is with all these companies, you have a lot of noise, you have a lot of macroeconomic factors that may influence your stock. You want 3 or 4 elements, the most important ones. That will be the main focus at the end of this step 2. Now, at this moment, I ask myself, do I understand the business? If I can't understand the business, it's a pass for me, and I go to another one. For example, before we've seen I had a list of 8 companies, so I start with the first one. If I don't understand the services or the demand the company meets, if this is not clear for me, it's a pass, and I start doing the research for the second business on my list. And then again, third company, fourth company, fifth company, etc., etc. Out of this list of 8 companies, maybe I will understand 3, maybe 4, or maybe 1, I don't know, but I will do the research until I really understand what the business does. My advice here is to be a harsh grader. If it's too complex, if you have a doubt, don't invest. You have plenty of other investment opportunities. So the goal is to invest only in companies that you really understand. So if I understand the business, I understand the products, the services, the customers, the geographical mix, I continue to step 3, analyzing financials. The objective here is to go deeper into the fundamentals of the business and to assess the business performance. And you can start with the income statement. You want to understand the company's accounting's earnings, what are the margins, what are the costs. I also analyze the balance sheet, which is a snapshot of what the company owns and owes. So you can see the debt, you can see the cash level. I try to compare these numbers. For example, you can have the current assets and you compare this with current liabilities and you see if the company can pay its short-term debt. So if the company, for example, has higher current assets than current liabilities, it means that they are safe and they can weather any negative events. I also analyze the cash flow statement, so you can see the actual cash movements within the business. What are the cash expenditures? What are the cash inflows, outflows? There are some tools to analyze these numbers. For example, you can think in terms of CAGR, compounded annual growth rate. And I want to analyze the compounded annual growth rate for 10 years. My ideal situation is when the 10-year revenue CAGR is inferior to 10-year net income CAGR, which is inferior to 10-year EPS CAGR. That means the business is getting more efficient, is doing some buybacks, repurchasing shares. Not all businesses are like this. And if you see this kind of situation, that's very good news. That's the kind of investment I like. Also, I like to compare financial statement changes over the years, how things are moving and why. For example, if you have revenue growth and then a deceleration and then the margins are changing, I want to dig deeper and see the 2017 annual report or 2018-19. I want to read everything about the company and see how numbers are evolving. What is the management saying at the time? What are the challenges? What are the threats? What is the competition doing? That's important because I want to know everything about the company. That's how I like to invest. I also calculate margins and ratios for growth, like revenue growth, net income growth, but also profitability. You have gross margins, operating margins, free cash flow margins. You can understand with ratios the operational efficiency, as we've seen before with our screener, with a return on equity. You also have return on invested capital, return on assets. I also want to understand the solvency of the company and the liquidity. If they have a lot of cash or a lot of debt, how do they manage their debt? And for all these ratios, I want to see the growth for the past 10 years, 15 years, 20 years. Is this business getting better over time? For example, you can compare the margins from 2010 and compare them to now. Are they better, worse than in the past? Is the business getting more efficient? You see the return on equity. What is the trend of the return on equity? Is it going up or down or stable? It depends. And it will change for every businesses. So that's where the analysis can be quite complex because you have a lot of numbers, but with a good checklist, a good method, that's quite easy to do. That's quite simple, and I already know what to look at. And when I analyze the competition, I compare their growth rate to my company, the profitability to my company. I compare the numbers. I compare the efficiency to see if my company has something special. And if they have something special, what is it? I want to know what is strange about my company, what is special about my company. Maybe all the companies in the industry are growing more than our company. You want to understand why. Why is that happening? Maybe that's different. Maybe our company is growing less, but is getting more and more efficient with better margins than competition. So the business model is quite different from competition. Again, understand the trends, how everything is happening. That's how you can have a clear picture about the industry, but also about specific companies inside this industry. Because maybe you can do the analysis right of a company and you understand 100% a business. But if there is something bad happening in the industry, it will touch all these companies in this industry. So it will touch your companies. And maybe you have not done the analysis of the sector and you will not understand what has changed about your investment thesis. So if you understand how the company works, but also how the industry works, that's good. You have a better picture of everything that is happening to your stock, to your investment. Again, you have everything in the annual reports. If you do the research right, you can find everything you want about your company. This is a public company, so all the information is public knowledge. You just have to know what to look at. There are some red flags to monitor. The first one is to see if there are some accounting irregularities, because sometimes I see something strange about a number. So maybe they manipulate the number, I don't know. Maybe they adjust for some metrics. For example, the company can use adjusted metrics, and I want to understand what is the adjustment and why is the adjustment made. Maybe that's logical and that's normal that they adjust some numbers, but maybe, and I would say most of the time, it's just to look better when people look at their financials. So be wary of adjusted numbers. That's another advice. Another thing that I want to check is how management is compensated. At the end of the year, the management has a variable bonus. This variable bonus depends on which metric. Is it linked to growth, revenue growth, or margins? So the management wants the business to become more efficient. Is it linked to EPS, earnings per share? That's important because if the management has a bonus that is linked to revenue, I can 100% guarantee that the management will do everything to boost the revenue. It will do acquisitions, sometimes stupid acquisitions, everything to boost the revenue, regardless of profitability, regardless of efficiency, regardless of the shareholders. On the other hand, you have management that is compensated with earnings per share, free cash flow per share, a return on invested capital, or simply the share price. So they want the share price to go up. Some metrics are better than others. I personally want to invest in companies when management think in per share metrics. So I would like for the compensation package to see per share incentives, free cash flow per share, earnings per share. I also want the management to focus on efficiency, so good margins, good operating margins, and you also want a return on invested capital. That would be my favorite incentives for the management. So again, this is completely public. You can check this information online. So you can see if the management is aligned with you as a shareholder and they want to invest for the long term, or they only want to be paid to boost revenue growth and do acquisitions. That's a different game and that's a different mindset. Also, when I do the analysis, I try to play the devil's advocate. I try to find what is bad about this business. And that's also the advantage of looking at plenty of external research reports is you can have plenty of ideas, plenty of opinions about your stock, your company. What is bad about my business? What is the main risk? What are the main risks? For example, what are the threats? Is a competitor eating their lunch? And maybe this is a no issue at the moment because the competitor is small, but they will grow. And in 5 years, maybe it will be a big risk. So I try to play the devil advocate to find the potential mistakes I may do in my analysis, to not be biased. The objective here is to see what can go wrong in my investment thesis. If you do all of these analyses, you will have done a great amount of work. You will be ahead of 90% of people, 95% of people, because most people don't do these deep analyses. So after all this analysis, if I still like the business and I still want to invest in this business, I go to step number 4, which is to understand the strategy of the business. The objective here is to understand the future plans of the companies. What are their priorities, their strategic priorities? Most of the time, management will tell you in investor presentations, our objective is to grow revenue for this amount, or we want to go abroad in international markets. It depends. Every company is different, so you want to see the capital expenditures, what are the strategic priorities, understand the capital allocation process of the business. Capital allocation is the most important part of being a CEO. If the CEO is a great capital allocator, it will work wonders for shareholders. So I want to see what are the plans of the business and how realistic their goals are. If they have a plan of investments, will it be financed by debt or by equity or by hybrid methods? I want to see how they will reach their objectives. So for that, you want to analyze the track record in executing similar strategies. The past is a good indicator of the future. For example, if for the past 20 years the management has been good at executing acquisitions and they want to continue the acquisition process for the next 5 years, you can have a good amount of confidence that they will do a great job at executing the acquisitions. There is a high probability that if they have done this for 20 years, they are experts at this. And what could be a red flag is when companies have had a strategy for 10 years, 15 years, 20 years, and right now they want to completely change their strategy. They go to another path and they don't have any track record in this new area. That could be strange. That would be a no-go for me because I don't have any track record to verify if the management is good at doing this task. So these are the things that could disqualify the stock I'm analyzing right now, and that's a pass. And I check another business, I go back to step 1. So this is a quantitative work, but it can also be a qualitative work. I analyze what management says and what management does. You want to see if when a management says something, okay, we will do that for the next 5 years, you want to see if they do that for the next 5 years. If they fail, that's okay, you can fail once. If they have another plan and they fail a second time, that's strange. If they fail a third time, that's a red flag. That's a no-go. So I want to check these for the past 10 years, 15 years, 20 years. Everything they've said, everything they've written. I want to see if their actions follow their words. In the stock market, you will find everything. Sometimes the management will promise you that they will reach 15% margins, and next year they reach 9% margins. And they will accuse everything, macroeconomics environment, inflation, supply chains, COVID, etc., etc., etc. They always have very strong excuses, very good excuses, and if they have charisma, shareholders will forgive them. But so try to be objective in this sense. If the management has reached its objectives for the past 10 years, 15 years, 20 years, I can confidently trust the management. The management is honest when they say something. and it increases the probability of the investment succeeding. Because if I buy this business and in 2 or 3 years they say something, they announce a new plan, I want to see if I can trust them. So the best case scenario is when management is competent, growth, good margins, efficiency, etc., and honest. You want to believe in what they say. So for this research, I'm looking at annual reports, quarterly reports, recent filings. I also watch the CEO interviews and I listen to earnings calls. I want to see everything that the management has said in the past and see if this happened, if they reached their objectives. Finally, after all this research, if I still like the company, I go to the last step, the valuation. The objective of the valuation is very simple. You want to see if the business is attractively priced. You want to see if the business is cheap, is fairly priced, or is expensive. I use several valuation methods. First, I start with relative valuation. I start with the PE ratio, price earnings ratio, also price to free cash flow. It can be also called free cash flow yield. What I want to see are metrics below 20. It means a PE ratio below 20 because I'm not comfortable paying a high price for a stock. I think paying a PE ratio of 35 or 40 is really expensive. Same thing for the price to free cash flow. If the price to free cash flow is below 20, that's good for me. These metrics are relative because you compare them with other metrics. For example, we talked about the PE ratio. If the business you analyze has a PE ratio of 15 and the PE ratio of the industry is 30, you could say, wow, there is a margin of security. My business has half the valuation of the industry, so this is safe. On the contrary, if you have a PE ratio of 15 and the industry has a PE ratio of 7, you can say that could be dangerous. That could be a risk. There could be a mean reversion, and my business is definitely not cheap in that situation. It depends on the industry. It also depends on the country you operate. For example, let's say, again, you have a PE ratio of 15 for your stock. The business is not in the US. The business is not in Europe. The business is in China. The PE ratio of China is on average 10. It means that on a relative basis, this business you're looking at is more expensive than the market. Is it justified? Is it better than the market? If this is justified, that's okay. You can pay a high multiple compared to the country it operates. But you have to do research. You need more work to decide if this is a higher premium business. Sometimes higher quality businesses deserve a higher multiple. They have better growth, better margins, better resiliency, management is honest, competent, etc. So why would you pay an average multiple? You just pay a higher price because it's a higher quality business. So that's the way I look at it. On a relative basis, you can compare price to free cash flow, price to earnings for the industry, for competition, for the country. And I also say that I don't want to pay a PE or price to free cash flow above 20. That's my personal style. So that's it for the PE ratio, for the price to free cash flow ratio. I also perform an absolute valuation method called the DCF, discounted cash flow analysis, where I try to forecast the future cash flow and discount them to present value. I have a simple table, a simple formula to do it, so it's quite convenient. And at the end, the table gives me an intrinsic value of the stock. It gives me an intrinsic value that I compare to the stock price. So I can clearly see if, based on my assumptions of growth in the future years, this company is cheap, fairly priced, or overvalued. I don't want to pay an expensive price. I don't want to pay a fair price. I want to buy when it's cheap. So I apply a margin of safety. Let's say the stock price is $60. I don't want my intrinsic value to be $60. I want a margin of safety. So let's say the stock price is 60. I want my intrinsic value to be at $90. It means I have a 30% margin of safety. That's a safe way to invest, and that's the way I do it. Most of the time, you have a vague estimation of intrinsic value. So that's also why I use the margin of safety. I don't care about precise numbers. I just want a rough ideas of, okay, it has a 40% potential because the intrinsic value will change over time, and as the business evolves in future years, the intrinsic value will move up, hopefully, if the business improves. So that's the way I see it. I don't use a complex Excel sheet. I just have a simple model, and for the moment it works well. So after all this research and the valuation work, now is the time to make a decision. Is it cheap or not? Do you have to buy or not? If the price is not cheap, if it's expensive, but you still like the idea, you still like the stock, what I do is I add the stock to my watch list to monitor over time. And I can monitor stocks for months or years. It's on my watch list. I've done the analysis. When something bad happens in the market and the price drops for any reason, I go back to the watch list, see my analysis, and I will buy it later. But it's not cheap at the moment, so I will not buy it. And if the stock is attractively priced, if the stock is cheap, that's the moment when I buy. And now I can add it to my portfolio and monitor the key performance indicators, the KPIs over time. The KPI that I've established before during my analysis. Normally, I've done the work before and I know what to monitor over time.
If you like this video and you want to go deeper, I've created a free guide called How to Outperform the Market with a proven investing strategy. Inside, I show you the exact method that helped me generate 25% per year, including how to build a framework you trust, how to find great stock ideas, and how to build a winning portfolio. It's the same process I use for my own portfolio, and it's 100% free to download. Comment guide below or click the link in the description to access your free investing guide. Just go down there, click the link, follow the instructions on the next page, and I will email you the guide 100% for free.